Recording in progress. Good morning, sir.
Yes, let's check members in the platform. How many are there?
There's only 4 members on the platform now, Chairperson.
It's 3 members.
Myself.
4 including Chairperson. Mr. Hadebe, Mr. Sukwati, Dr. Beck, and Yuse.
No, Mr. Hadebe is from National Treasury.
Oh, it's not.
Oh, sorry. Yeah, I made a mistake. Yeah. Okay.
Hey. Colleagues, members of the standing committee, can you please assist by checking our colleagues if they are available to just log in so that we can start the meeting?
Working on it, Chair.
Sure, Dr. Beck. Honorable Squad.
Honorable Alexander should be shortly, Chair.
Okay, thank you.
Chair, I believe we should have enough numbers now.
Let's check. How many members?
We have 6 members on the platform, Chairperson.
Okay, who are the 2 who joined?
Ms. Alexander. Yeah, Ms. Alexander and Ms. Alek. That's right.
Okay. Let's start because we are supposed also to be attending the mini plenary sessions. Let me put the agenda here. Put the agenda on the screen for everyone to see. There is the agenda. The meeting is officially open. Members of the Standing Committee Finance are welcome. Stakeholders are welcome. Parliamentary officials are welcome. PBO, media, all of you are welcome. Number 2, roll call and apologies. Sister Tebogo, okay.
We have an apology from Mr. Lekhanyan, sir. That's the only one we have.
Okay, let's record that apology. I think it's attending the ad hoc committee. Then let's move to item 3, where we invite stakeholders to make inputs. This is a public hearing on the Tax Administration Laws Amendment Bill, TALAB, and the Tax Laws Amendment Bill is TALAB and TLAB. So there we are. Let's check how much time is that the PKF? Is it 10 minutes?
10 minutes, sir, but we can make it 15 minutes because it's only 4 of them, if it's okay.
Okay, 15 minutes.
Chair, could I propose we do 10 and leave some time for questions?
There'll be enough time for questions. It's only 4.
Dr. Beck, you suggest how many minutes?
10 as we had it and leave more time for questions. Chair, it's part of a bigger request that when we have folks, we contain the presentations and we increase the time we allocate to back and forth questions.
Okay. Let's stick to 10 and then we have time for questions. It's not a problem. PKF, are you there?
Yes, I am. Am I audible and visible?
Yeah. You are welcome.
I just want to share my screen quickly.
Submission. Can you share the screen with us? And please time yourself so that I don't disturb you towards the end when you have to do the conclusion. So I have a timer in front of you.
Can you see the screen?
We see there's something written Zoom on top here. We don't see your screen. We see you.
You see it now?
Okay. There you are. Yeah. Please proceed.
Okay. Good morning to the Chair and the honorable members of the Standing Committee of Finance, National Treasury, SARS, and my fellow stakeholders that are present here today. My name is Kubashni Mudli, and I'm a tax director at PKF, Chartered Accountants and Business Advisors. I wish to express my sincere gratitude to the Standing Committee for affording me the opportunity to present to you today. Before we actually look at the concerns that we have regarding the revised bills, I think it's important that we take a step back and really just look at the process, the legislative process, and how this year has been quite different to the previous years. Apart from the 3 budgets that we had this year, I think that aside, this table, which contains a lot of information, is really just to illustrate the time frame from which the tax proposals are submitted by the public or requested and submitted to the time that the bills are actually promulgated. And to also note, more importantly, that this is the first year that we've actually had a public consultation on the revised tax bills. And we really want to acknowledge and thank the Standing Committee for allowing us to actually make these representations, because public consultation is of utmost importance. With regards to the table that was presented previously, so although I didn't go into detail, some of the key points that I really want to make in this regard is the balance of time that's afforded to National Treasury and SARS to draft the legislation and amend the legislation as compared to that afforded to the public, as well as the Standing Committee to actually look at the proposals and make proper recommendations or amendments. So if we look at something as simple as the Annexure C proposals, which coincidentally enough is due today, we were given only 20 days last year, noting that last year was a standard budget. There was no issues in terms of the process. And this year we had 11 days. And now these are calendar days, sorry, not business days. So if you look at the amount of time that the public is given to actually submit their comments, it's a very, very short period, and it makes it very difficult for proper proposals to be submitted. However, having said that, some of the proposals that are submitted year on year, and is not always taken into consideration. And we've had only one workshop in the last 5 years where National Treasury and SARS did engage with stakeholders to address the proposals that weren't actually dealt with for many years. So long outstanding proposals that were submitted, but were just not being dealt with. But as the tax fraternity, I think we're quite strong-headed, and we keep pushing these proposals year after year, hoping that at some point they will be looked at properly. If we go to the budget day, which is generally in February of every year, this is literally 2 months after the proposals are submitted. And I say 2 months because I've obviously sort of minus the festive period. So it's probably 2.5 months, but let's say 2 months. So for SARS and Treasury to actually consider the proposals that are being put forth by stakeholders at such a late stage in the year, to then come up with the main tax policy recommendations, which are announced by the minister in the budget in a 2-month period, it is, I think, quite probable that a lot of the submissions that are made are not properly considered. And this year, I do thank the Standing Committee, Parliament, for requesting that the Annexure C submissions separate out tax policy submissions and the technical submissions, because we generally do it together, and I think a lot of the policy recommendations are overlooked. So I do commend the requirement that this be separated, and I hope that it will be looked at properly in the next cycle. If we go on to the tax bills, the draft tax bills, so not the rates bill and the money bills, these are only released around July, August of every year. And this is really 6 months later after the main tax proposals are announced by the minister. So if you look at the total amount of time the Treasury and SARS are allowed to draft the legislation and come up with major tax policies for the upcoming year, they're granted 8 months out of 12. And the consultation process is generally limited to 3 months. And this year, thankfully, because of this additional public hearing, we've had 4 months of public consultation. And I must say that there's been a lot of progress in our view in terms of SARS and Treasury really looking at the comments and properly assessing them and accepting or partially accepting a lot of them, as well as noting some for further consideration or deliberation. And then lastly, these bills are then promulgated within a month or two. But this session and the importance of these consultation process cannot be stressed enough. I think it is important that we strike some sort of a balance to ensure that there is proper engagement by the public, because we do make valid submissions. We make policy submissions that are being put forward by Treasury and SARS are sometimes not practical. And we have seen that this year with the withdrawal of the proposal on the preference shares that was going to have significant economic impact on our country and was actually withdrawn before the actual due date for submission of comments, which I think is unheard of in this arena. We also seen other major policy shifts on proposals where exemptions have been allowed for specific reasons for the last 30 years. For example, the foreign pension exemption that was going to be removed. For now, it's temporarily being pushed out for further stakeholder engagement. However, having said that, and there's quite a lot of uncertainty when these types of proposals are made without proper consultation, because it causes potential shrinkage of the tax base. So if you just look at the foreign pension exemption proposal to actually have that removed, in those National Treasury workshops and the committee workshops, there were actual individuals, so not the general participants in these workshops, but they were South Africans living abroad that are not seizing tax residency because they are wanting to return to South Africa on retirement. They are foreign high net worth individuals that are wanting to retire and use South Africa as their destination for retirement purposes. And these individuals are now saying, well, if you're going to pull this off, then we're not coming back to South Africa, or we're not going to use this as our retirement destination. And that effectively shrinks the tax base. We want to enhance our tax base. And I think we want to also make it clear that as stakeholders, in this 3 to 4 months, we provide a lot of valuable content, and we do try our best to really assist Treasury, noting the constraints in terms of the ability to draft legislation. On looking at the revised bills, the VAT on the low value importation of goods, I think the fact that there's still no effective date for implementation is a serious concern to us. The last 2 budget cycles have been allocated substantial resources, 3.5 billion in 2024, 7 billion in 2025. And the change in the customs system on this low value goods was effective more than a year ago. So we're proposing that there at least be an implementation date fixed of 6 to 12 months from the promulgation of this bill, so that we're not then sitting with an open-ended implementation of the VAT on low value goods, and that this really be prioritized. With regards to the rates, this remains a problem. Constitutionally, this Section 7.4 and the powers of the minister has had major issues this year, with it going to the courts to rule on, eventually being settled out of court. So we still don't have any certainty. And I think we really need some review of the various rates. So it's not just the VAT, but the various tax rates that allow the minister to make these amendments effective from the date announced in the budget. And so we request that Parliament look at all of these provisions. Finally, extension on the ring fencing of assessed losses to middle income earners. We have requested, there's a lot of various requests that were put forward from stakeholders. Our request specifically on the fixed property industry to have some sort of carve out, because we really do want to improve the future of high net worth individuals, and the middle class really is that future high net worth individual pool, which is the highest contributor to our tax revenue. And we cannot actually have a country where high net worth individuals are immigrating and are actually wanting to leave the fiscus and make the tax base even smaller. So we want to encourage savings, and we want to ensure that this carve out of 3 to 5 years is not really applicable to all industries. Chair, I do see my time is up, but I'm happy to take questions thereafter. Thank you.
Thanks very much, PKF. Please proceed and invite Old Mutual to make a submission. Old Mutual, are you there? And please time yourself.
Hi there. Thank you for the opportunity to present to this committee. Just want to confirm that you can see my screen. Chair, can you see my screen?
Yes.
Okay, thank you.
Standing Committee on Finance, Taxation Laws Amendment Bill.
Yeah. Okay. So the first one we want to discuss is the asset for share provisions. So the original proposal that was made by National Treasury was to exclude collective investment schemes from the group restructure provisions, as well as, which includes the asset for share transactions and amalgamation transactions. After the submissions from industry, National Treasury deleted the amendments relating to amalgamation transactions and have delayed the implementation of the amendments relating to the asset for share transactions to allow for further consultation on that legislation. With respect to the asset for share transactions, National Treasury stated in its presentation to SCOF that the proposed amendments will go ahead with the objective of preventing misuse of Section 42 rollover relief in cases where individual investors initiate asset forfeiture transactions to avoid TGT. Now, the aim was to stop individual investors, but the way the legislation is written currently, it actually stops all investors, not just individual investors, as National Treasury noted in their comments. So the inclusion of potentially flawed legislation, even with implementation date, in a future implementation date, creates uncertainty in the market, because I, as a tax practitioner, am required now, because this legislation, in the Act, even though it may not be effective, to take that into account. So our recommendation is that the Section 42, like they've done with 44, delete it from this Act here. Once you've done your consultations next year, come up with the correct legislation that you want to implement, then bring that legislation back, rather than putting something in that's not quite right at the moment. Okay. The next one we want to deal with is capital distributions. So the proposal in the legislation is that all capital distributions by collective investment schemes is subject to capital gains tax in the hand of the unit holder in the year that the distribution is made. Now, in our commentary or mutual commentary to the draft taxation laws amendment bill, ASISA also had a similar comment, and other market participants had similar comments. We stated that there was no reason that management companies should not be in a position to apply a reduction in base cost. So National Treasury, when they proposed this legislation, they said that they got feedback that collective investment schemes are not able to track the base cost of the investor. And therefore, a simpler alternative would be to treat all capital distributions as a capital gain. Now, Old Mutual and ASISA, which is the representative body for a number of collective investment scheme management companies, of the view that, well, actually, you've got a legal requirement for the management company to track the base cost, because otherwise, how else do you do your IT3 reporting, which requires you to calculate these base costs? Now, yes, not everybody uses that calculation. Some taxpayers may opt to do a weighted and another base of calculation, but then they keep their own record for those purposes. So our view is that NT's understanding of the base cost data that CIS and management companies have is incorrect. And the impact of this here is that if you get a capital distribution in, say, year one, for example, and the investor then has to pay capital gains tax on this distribution that you received, and in year two, the investor sells this unit at a loss. So in year one, the investor will pay tax. In year two, although he's got a loss, and assuming he doesn't have any other capital gains to set it off against, he doesn't get any tax benefit from it. So he's actually paying tax without getting the deduction when economically he made a loss. The Old Mutual therefore requests that NT reconsiders its proposal and revert to the original proposal that National Treasury had in the discussion document, where capital distributions firstly reduce base cost. And this aligned with the treatment that we currently use for equity shares. We think this is a more fairer basis of doing this here. The next one we want to deal with is the taxation of unlisted properties. Now, after various representations that we had made to National Treasury, as well as the Standing Committee of Finance, in the last round of amendments, concessions were granted to unlisted property sector that allows unlisted REITs the same tax concessions to listed REITs, subject to regulations that are yet to be published by the Director General of National Treasury. Now, unfortunately, these regulations have not yet been published. I mean, initially, NT gave us informal guidelines. It wasn't any formal guidelines, just informal guidance, and they expected these things to be released in the first half of the year. Now, we understand, this year Treasury, because they have to rework the budget, has been under extreme pressure. But we want to make an appeal to expedite these regulations, or at the very least, give us some sort of indication of the timelines of when these regulations would be released. This would help with business planning because, I mean, these regulations make a significant difference to how a business would be run and how it would be structured. And as long as these regulations are not published, the issues that we raised that actually caused the amendment to be promulgated in the first place continue to be in place. The last one I want to deal with is the unlocking of institutional funding for infrastructure. So similar to the issue that we had raised on unlisted properties, we had also raised the issue of where retirement funds invest in infrastructure projects, which is a priority area for our government. That the interest limitation rule in Section 23M in certain instances could apply to limit interest deductions in the infrastructure vehicle, which would then impact the returns to the retirement fund and ultimately to the pensioners. So in Chapter 4 of the 2025 Budget Review, National Treasury highlighted the intention to publish a consultation paper on unlocking institutional funding for infrastructure. It said it would propose certain investment vehicles to be enabled to facilitate such investments and would offer flow-through tax regime. Further consultations would take place in 2025. Unfortunately, to date, no consultation has been published and there have been no consultations as well. Now, we expect normally, from the time a consultation paper is published to the time that the legislation is finally effective, it's quite a long process that has to occur with a whole of consultation. You can draft legislation and that. So what we're recommending is that National Treasury implement a stopgap measure, which will carve out from the interest limitation rules where institutional investors make investments in infrastructure projects to soften the impact of this interest limitation rules. We have in our letter suggested certain amendments, which I'm not going to go through here. I thank the committee for their time.
Thank you, Michon. Weber and Wenzel, over to you.
Good morning, everyone. Thank you very much for this opportunity to present to the committee members. Okay, I need to share my slides. Thank you very much. I've managed to share my slides. Fantastic. I feel I've achieved my goal for today. Wait, no, I haven't. Please, can someone tell me whether I've shared my slides? Okay, can you see my slides?
We don't see your slides.
Pressing the share button would help. Can you see my slides now? No.
We can see it. Two issues. That's what is there on the slide, and then.
Oh, yeah, okay, fantastic. All right, it is the slide. It is the slide. Apologies, I'm more used to sharing on Teams. Can you see the two issues?
We see the two issues.
Fantastic. Let me start. Thank you very much, everybody. So today I'm going to be talking about two issues. The one is the proviso capital D in section 9 capital D2 CFC rules, where the omission in the TLAB is affecting CIS and hedge funds, but it does not affect CIS and securities. The second issue is on paragraph 82 capital A, and I thank very much Old Mutual for their detailed submission, as Asisa has also done in the cycles, in the tax legislative cycles. I support very much what Old Mutual has discussed earlier, and I probably need not repeat what has been discussed. So I'm going to focus my presentation on the proviso D in section 9D. Now, this is an interesting presentation because it's not going to be commenting on what is in the Taxation Laws Amendment Bill, but it's actually a discussion on what is not in the Taxation Laws Amendment Bill. Now, it goes to the proviso capital D in Section 9 capital D of the Income Tax Act. What is Section 9 capital D? It is an anti-avoidance section to prevent residents from moving their income, which should be taxed in South Africa, to be taxed in a lower tax jurisdiction in a foreign company. So, for example, if I sell wine to Marks and Spencer in the UK, and I say to Marks and Spencer, don't pay me in South Africa, I have a Mauritius company, it's subject to tax at perhaps 3%. I have a marketing employee in the Mauritius company. I own all the shares in the Mauritius company. Marks and Spencer rather pay the Mauritius company. It's only taxed at 3%. They will deal with all the marketing there. Section 9D is an anti-avoidance section to deal with just this scenario. The Mauritius company is going to be a controlled foreign company. The net income of Mauritius Co., a controlled foreign company, is going to be calculated using the principles in the Income Tax Act, and the net income will then be attributed back to me and taxed in my hands as a 100% resident shareholder of Mauritius Co. That is the purpose of Section 9 capital D. Attribution of CFC net income to South African resident shareholders, subject to nuances and exclusions, which we won't go into. Now, Section 9 capital D hinges on the definition of company in Section 1. For now, as of today, company includes a foreign portfolio of a CIS in securities, and from this date, a foreign portfolio of a CIS in hedge funds. So I'm going to tell you a brief story about the Collective Investment Schemes Control Act, which is shortened to CISCA. Broadly, when you look at CISCA, which governs unit trust, SATRICs and so on, you've got two broad types of CIS and securities. You've got two broad types of unit trust or collective investment schemes. One is collective investment schemes in securities, which is governed under Board Notice 90 Fiscal Notice, and the other one is collective investment schemes in hedge funds, which hedge funds were brought in under the auspices of CISCA from 2015. So they were brought under the regulation of CISCA hedge funds, and they are known as collective investment schemes in hedge funds, and there are corresponding definitions inserted into the Income Tax Act to that effect. And CISCA, CIS in hedge funds are then regulated under Board Notice Fiscal 52 and General Notice 141. So they're broadly then under the universe of unit trusts or collective investment schemes governed under CISCA, CIS in securities, and CIS in hedge funds. They are both regulated investment vehicles subject to oversight, regulation, close scrutiny, reporting obligations of CISCA and trustees, and very strict obligations, statutory duties on the manager of these collective investment schemes. For all intents and purposes, they are equal regulated investment vehicles under CISCA, which go out, pool investments from the public, and invest them. That is the purpose of these unit trust investments. So what we have here is that we have a feeder fund structure potentially for unit trust, where a South African feeder fund, I'm going to use a SATRICS feeder fund, for example. The SATRICS MSCI ACWI index fund is a feeder fund. The SATRICS feeder fund means it gets RAN investments by the public, such as yourself and myself. We invest in the SATRICS MSCI feeder fund, equity feeder fund. And what SATRICS does is that it then takes our RANs and it invests into a global fund. Now that global fund is a foreign unit trust. How these feeder fund structures work is that what usually happens is the global unit trust will be set up by the South African feeder fund, the South African Satrix Fund, and 100% of the contributions invested in the South African unit trust is then transferred to the global unit trust fund, which then invests in all those foreign shares and South African shares and so on. So then your global fund will then have a growth in assets value, which will then be reflected in the South African feeder fund asset value, because 100% of the feeder fund is invested in the global fund. So when I invest in a Satrix feeder fund, I will get gains reflected in the global fund. 100% of the economic rights of this global fund is held by the feeder fund. And because it is a South African feeder fund, Satrix, for example, there's a very, very high chance that more than 50% of Satrix fund is held by resident investors. The global fund, 100% of the Satrix fund has been contributed to this global fund. There's a very, very high chance more than 50% of the economic rights of this global fund is held by the Satrix feeder fund, a resident taxpayer. So inadvertently, you've got a global fund set up by a South African unit trust feeder fund, which is going to be a CFC. Why? Because when you look at the definition of company, it includes a foreign portfolio of a CIS in securities, and from this date, a foreign portfolio of a CIS in hedge funds. This is not intended, the Section 9D regime is not intended to apply to these feeder fund structures, because they're very different to that Mauritius Co. that I set up to receive the receipts of the sale of wine to Marks and Spencer. The global fund scenario, global unit trust scenario, is an investment vehicle scenario. So the Taxation Laws Amendment Act extended company to foreign collective investment schemes in hedge funds, but Proviso D was not similarly updated. Now, we raised this issue with National Treasury on the 3rd of December 2024, which is the Annexure C workshop. National Treasury indicated that it was an omission, an error. It would be corrected with retrospective effect. We don't see this Proviso D amendment in the draft TLAB, and there's as well nothing in the 4th November response document as well. So I want to now share the notice, which is FSCA Communication 5 of 2024. Please, can someone just tell me if you can see this notice? Yes? Can you see this notice?
Yes, we can.
Thank you. Thank you very much. Now, the FSCA did not envisage that Board Notice 52 would exclude the establishment of a feeder retail fund as a portfolio style or type, and that the limit would have the effect of prohibiting it. It is acknowledged that feeder funds are an industry norm internationally and should be available in the spectrum of portfolio offerings. So back to my slides, which I hope you can see. So this is the FSCA Communication 5 of 2024, expressly acknowledging that you can have retail hedge fund unit trust, South African retail unit trust, which then invests into global hedge fund unit trust. This is already recognized by the FSCA. They issued a Communication 5, but the tax law hasn't made that necessary amendment. The result is an unfair, unjustifiable discrimination against the South African feeder fund, hedge fund, and also a global hedge fund which the South African hedge fund feeder fund is invested in. Because your CIS in securities feeder fund, your Satrix feeder fund, for example, enjoys the certainty under Proviso D, but the feeder fund, hedge fund, doesn't have this uncertainty. Potentially it has C treatment, potentially its investors have to pay double tax because there's economic double taxation and so on. 25BA, does it apply or not? So there isn't, besides the constitutional issues which I've alluded to, there is an internal inconsistency within the Income Tax Act, and there's a misalignment with SISCA and the FISCA regime. So we recommend that this insertion is made urgently into Proviso D with effect from 24th December 2024. This is to align the tax treatment between CIS in securities and CIS in hedge funds. There is no reason to differentiate between the two. It will restore coherence. FISCA and National Treasury both report to Minister of Finance. This is to enhance legal certainty, rule of law, and consistency in tax policy. Thank you very much. On the paragraph 82, capital A, I want to put my support into what Old Mutual and Asisa have already commented, and I think they have dealt with it comprehensively. Thank you very much. That is my presentation.
Thank you. The next stakeholder, SA Institute of Chartered Accountants.
Good morning, Chair, and good morning to the honourable members this morning. Try and see if we can get slides going. There we go. Chair, we'll look at 5 issues. Some of them are the same as on the first, with some adjusted for the feedback from and the adjustments made from the first draft and the feedback given by SARS and National Treasury. Chair, we raise the point of public consultation. I think the members are tired nearly of this point, but I think as the Minister of Finance had noted both after the budget and as well after the withdrawal of 8E, that we are still finding each other, and I think the same with Parliament. There are certain, and this is a process, so we'll continue to develop it. And given that this is probably the last time this year we'll be engaging with Parliament, and a lot of this process on the budget's already 6 months in, so about an 18-month process. Most of these discussions are in preparation of hopefully changes we'll see in 2026, where we'll probably only get to see Parliament again in after March, which is already after in the first quarter, the end of the first quarter hence. So a lot of this, again, not criticisms, but rather that we build on what we've done. So again, we welcome the second hearings on the amended bill, and also the further changes like on the fiscal framework that the Treasury have been making, and we look forward to those. So what are the concerns we have, Chair? You've noted the concerns by PKF as well on the bills are being too short, but I also like to mention it's not just the public that has this problem. I think Parliament suffers from the same, that Parliament has to deal with various aspects, banking regulation, audit regulation, financial, and tax, and therefore it too needs a lot more time to actually look at these bills. The amendments made by SCOF are still not subject to public consultation, so the committee will go back. The committee will or will not make amendments, but there probably won't be another hearing on those actual amendments and whether they are material or not, which in itself then becomes a problem. And that problem arises due to the current process and the ordering of timelines as we had presented in October, Chair, is that at the moment, this hearing is probably what should have been the first hearing. Why? Because the first hearing was merely a duplication of the National Treasury workshops, because Treasury and SARS had tabled and presented to Parliament on drafts that had not incorporated the public consultation input yet. And that's, as we had said previously, if that had already incorporated it, this hearing probably would have happened in October, and Parliament would have started its process already with the post-amended bills and wouldn't have to duplicate the process. As a further point, Chair, the explanatory memorandum that gets issued, essentially, which is a statement of intent, remind that that statement of intent should actually be from Parliament, because it is Parliament that is actually the legislature and is accountable. So on those recommendations, Chair, we look forward to looking at a minimum of a 30 time day period. We too have to look at various aspects, including policy aspects, practical aspects, and you'll see some of that coming through later on. That we already revised, so that Treasury and SARS only table the post-amended bills, so the version after the public have already commented on, and that we also have comments for bills and policies on budget day, so bringing that process earlier together with the Division of Revenue and Appropriation bills, that we have those drafts already issued together with all the legislation. And that, again, we asked for written feedback, again, for the matters that are not included. We asked that in detail. And that SCAF then, if the explanatory memorandum is a reflection, then separately adopts an explanatory memorandum version to say, well, this was our intent with the legislation, because it is Parliament that remains legally accountable to say why the legislation was passed. On technical matters, Chair, looking at the VAT exemption of schools. So again, we welcome that Treasury is seeking to assist schools and to reduce tax compliance. We've now had a little bit of time just to think about the practicalities of, and there are some, and you'll see now our detailed submission, things like, for example, who's going to initiate? There's two, the commissioner can initiate or the taxpayer can initiate. There are two different processes, and there's still uncertainty who in this proposal is expected to initiate. Given the proposal that the deferral of the payment will be deemed supplies in future, it means that there can't be deregistration, because there will still be supplies to be made on the exit VAT back into 2027, maybe 2028. So these people might still be on the VAT system for another few years, having to submit zero returns in 2026. And then there are differences, obviously, for VAT. You have both equal and unequal periods. So some of them run November, December, but others run December, January. And then obviously, when do I claim my loss, given that some of schools, a lot of schools pre-sell some of these things like supported jerseys, etc. So there might be supplies made that are only delivered in the new year, and how do we actually treat that so there's some form of matching given the prohibitions in the new 40E. So there's some practical challenges, Chair, and we look forward to withdrawal maybe of this proposal and more discussion on the practicalities of what's happening, so that we don't hit the road in 2026 with practical challenges. And given that we've already agreed to the actual financial impact happening only in 2027, it's therefore not sure why we can't then also postpone the whole proposal to get all the challenges for 2027. Legal notices, we've raised this at first. We've noted that this is a constitutional issue, not, as SARS had noted, it's merely an administrative matter, Chair. And SARS noted that they've moved it from section 11.5 to 11.4 to make it just a form requirement. We believe that does not happen. It's not just a form requirement. It, in fact, remains a constitutional limitation. We recommend that this should be withdrawn and that there's no suffer of detriment or abuse to SARS, only to the taxpayers. And should they propose that there at least be Parliament expressly looking at this as a constitutional limitation, essentially SARS noting that they would be looking for additional information or reasonable information, and what would be that reasonable information, and on that we request that that specifically be stated in the legislation and not in some discretionary form, so that we don't see further court cases. So the impact of this is, if it does go ahead and there are disputes, what would happen is a taxpayer would then have to first go to court to dispute that the notice was valid before it can actually go to court to actually put SARS on notice on the actual issue. So that is the risk that we have in proceeding with this proposal. On the Section 18, I'm not going to say much. Again, we welcome SARS's ability to approach this from a pragmatic point of view. However, we still believe that they haven't actually got to the crux of the issue, namely the actual scope of the assurance. And when we actually look at the legislation, you'll note that parts in yellow still refer to all, and it also refers to that the validation. So the fact that you're saying that a registered tax practitioner must have reasonable satisfaction, that is only what he must do, and the public notice will prescribe the information for that. But the scope is still 100% in respect of an after-the-fact confirmation of an activity. And that is the element that we believe should actually have been in the public notice, where it's still in the actual legislation. Therefore, we've request that also be reconsidered, and that scoping of what exactly, and that we also recommend, as we have in the last few years, that SARS engage either the public or the audit and assurance regulator, IRBA, to understand how to put a matter like this into wording so that we actually achieve the outcome of reducing the obligation. Chair, the last matter we want to deal with is on bona fide inadvertent error. Now, SARS claims, so this is an error and a remedy in respect of an understatement. So this is an additional penalty that is imposed above all other penalties. And what it seeks to do is to say, if you are so egregiously guilty of mind and action, that's what we refer to the table of behaviors, we're going to impose another penalty on you. So it's not as like a strict liability to say, oh, you just submitted late or paid late, and therefore we don't care what you intended or had in mind. This penalty in principle specifically deals with your state of mind in this regard. So SARS's response was, well, our comments are misplaced, and we believe our comments are not misplaced at all. Firstly, there's a policy issue. So one of these behaviors that SARS cite is just a monetary amount. Now, I don't know about the members, but a monetary amount is never a behavior. So in law, we talk about the act is not culpable. So we talk about culpability, and in SARS's response, they always refer to culpability. Well, culpability refers to your state of mind. R1 million or 5% threshold is not a state of mind. So in principle, that first behavior, as SARS calls it, is not a behavior at all. It actually ignores the behavior and undermines the principle. But the second point is this proposal of SARS saying, well, we're just moving it one section. It doesn't really undermine the principle. And we have to still respectfully disagree with SARS that that's what's happening. So before the penalty is imposed, SARS must prove, firstly, that an understatement existed, and obviously they'll look at the behaviors, etc. But then, and this is what the court found in Thistle case, is to say, but if the taxpayer alleges that there was a bona fide inadvertent error, namely they weren't culpable at all, then SARS must first interrogate that before it imposes the penalty to say, we looked at it and yes, we agree, you are not culpable and therefore we cannot impose the penalty. What SARS is proposing in this small movement is to say, no. What we'll do is we'll deem you to be guilty and culpable and we will impose the penalty. And then after the fact, you'll come to us and say, no, but there was these facts. And if we agree on the fact, we can remit the penalty as if you weren't guilty to start off with, even though you weren't guilty at all. And I think this is a fundamental departure of the process. And even though SARS says, well, Thistle remains, or the remedy, effectively it doesn't. Why? Because that's what the court found, is that SARS must first look at whether you are culpable, then impose the penalty. If we want to impose the penalty by law and then determine whether you're culpable or not thereafter, then there's no remedy at all. All that we've done is we've now put SARS in a position to say, well, we've got this penalty hanging over your head. Let's look at the remission criteria. So I don't think we should have law that finds people guilty before and then ask them to find themselves innocent. Let's continue. And on the recommendation, we ask SARS to maintain the fair and legal basis for additional penalties and that this proposal be withdrawn from the law. Thank you very much, Chair.
Thank you, Saika. Our next item, deliberations. Honorable members, there we are. Stakeholders have presented or made submissions to the two bills that are before us. Dr. Beck. So now we can ask questions, we can make comments.
Thank you,
Dr.
Chair.
Beck, over.
Chair, just one actual comment from me is that given the complexity of these issues and the fact that we've had really limited time here, I think we need to, as a committee, and perhaps the content advisors can help us with this, attain a table of what changes have been made from the previous version of these tax laws to the current version of these tax laws. And that table crucially needs to contain the particular concerns that the stakeholders now have. I tried to follow some of the Weber-Wenzel complexity. It almost seems like they had pointed out a caveat and then Treasury agreed but Treasury didn't actually update their tax laws to get rid of the caveat. So I hope, Chair, that from the content team we can get a bit of a table representation of what was in there, what's in there now, and how does that address the concerns that we've heard today. That's the overarching question. For SAICA, I just want to make sure from Mr. Faber that I understood correctly. Am I understanding that with section 222, what SARS want to do with the penalty is essentially say that you are guilty until you're found innocent, which of course would be concerning if that's correct. And to PKF, I hope I'm not putting you on the spot here. Thank you for pointing out the problem of timeframes for National Treasury versus the time to respond for the tax industry. What does your alternative timeframe look like for this, especially for the consultation? And I guess more generally, I think some of the committee members raised this point before. I have a lot of sympathy for the idea that we need to have public consultation, but of course, for every consultation, if we then have to bring changes, we'll need more consultation, which is an infinite loop. So yeah, just without putting PKF on the spot for immediately coming up with a solution when they've just finished identifying the problem, it would be helpful for us to understand how they're thinking about it. That's it from my side, Chair.
Thanks, Dr. Berg. So the first question, you will want the researchers to assist with putting out the information to be more clear as to what the content is all about. Is that what you are asking?
I think so. I think so, Chair, especially if the table's rows can reflect the pertinent issues that have now been raised. I think, for example, of CIS, we had a version, then some changes were made. I'd like to understand what those changes were. And then in the researcher's view, how much of the industry concern has been addressed by those changes and how much has been left unaddressed. Likewise, we might say for the schools VAT issue and some of the other issues now raised. So yeah, I'm thinking a couple of rows in a one-page table that helps us to try and distill between these two versions of these bills, what we have now versus what we had, and how that addresses the industry concerns. I hope I'm being clear enough to the content research team.
Yeah, no, you're clear. So the research content and National Treasury and SARS will help to do that. It's their daily work, so I think they understand very well what you are asking for. Sister Teboho, you will follow up with our team and National Treasury and SARS to simplify the table and do as Dr. Beck is asking. Any other member who wants to make an input? Is there anyone else from your side? Okay. Honorable Squati.
Thanks, Chair. And good morning to yourself and colleagues who are on the platform. Just to understand and welcome the presentations that have been made by stakeholders. Just to understand from Old Mutual, Chair, in terms of the concessions that they're talking about in terms of taxation on unlisted properties, as to whether do they have a framework of those concessions, or they're just saying that perhaps Treasury and SARS should just look at what kind of concessions they could actually bring about in terms of the unlisted properties. Just that, Chair. Thanks.
Okay, thanks, Honorable Scotty. I hope the stakeholders will respond. Yeah, those are the two inputs and or questions coming from the two members. Let's start. PKF, did you pick up a question that's relevant to you from the members?
Thank you, Chair. Yes, I did. Thank you very much for the question. I think it is very much necessary for the process to be re-looked at. Whilst I might not have the magic answer, I would potentially suggest that if you just take cognizance of the slide, that generally speaking, the Annex C requests for tax proposals are happening in November. As I said, we only allowed less than 2 weeks or 3 weeks to actually make those submissions. So in my view, I think if we had to move that process earlier, which is the actual start of the entire cycle, to possibly August, September, that probably would make more sense, because it gives National Treasury the ability to actually look at that proposals in more detail, and hold the necessary workshops to discuss the proposals, and also to address the long-standing issues, because we have had a workshop previously on the long-standing issues, some of which were noted, similarly to the presentation by Weber Wenzel, where it was noted that Treasury agreed that this was a problem, that they were going to fix it, but it hasn't been done. We've had similar proposals that were addressed in those Annex C workshops on, for example, the hybrid debt instruments under Section 8F, and requesting a carve-out, because the practical application of one of those sections actually is a major concern for tax professionals that are SICA and URBA members, because the actual legislation is not practical in terms of what is required.
Whose mic is on? Please mute. There's somebody who has opened the mic on the background. Please mute, colleagues. Yeah, Ms. Model, please continue.
Thank you. Thank you, Chair. So yes, I think if we had to move it forward to perhaps maybe instead of November, look at submitting Annex C proposals and having the relevant workshops earlier, possibly August, September, and having the workshops on those Annex C submissions, maybe October, November. And then the actual releasing of the bills, I think a time frame of 6 months from the day of the budget to the actual releasing of bills needs to also be moved forward. Possibly to end of April, May would probably be more practical, because that would allow then for a more balanced consultation process. So I think that would be my recommendation. Thank you, Chair. I don't think there were any other questions for me unless I missed anything.
Yeah, that's all for now. If there are follow-ups, the members will indicate.
Okay, thank you.
Thank you for the question.
Yes, thank you very much. Sorry.
Yeah, thank you for the question.
Is there a question?
Was all mutual, eh? So on the unlisted property concessions, so the concessions that are granted are already in the act and they're already enacted. What is required still to happen is the regulation. And what the regulations do is they simply say who actually qualifies for these concessions. And that is what is outstanding. So the concessions, as we said, is already there. It's in the legislated. It's just the regulations on who to qualify that's outstanding that we're looking for. Thank you.
Thanks. Weber and Vincent, is there a question for you?
Yes, there is a question. My apologies, all mutual. I didn't mean to jump the gun there. Okay, so definitely the question is on what was in the bill before and what is in the bill now on the very specific issue of the Proviso D. I think that what was in the bill before in Proviso D, this is the July 2025 bill, is that there was nothing. There was no amendment on Proviso D, although there was acknowledgement by National Treasury on the 3rd of December 2024 that there was an error. So what was before? Dr. Berg, I think you're right. What was before in the bill in July 2025? Nothing. And what is the current bill that was tabled now at Parliament? Still nothing. So this is an omission, and it is a serious omission because it results in discriminatory treatment, which is unjustifiable against CIS Global Hedge Funds and CIS Hedge Fund Feeder Funds. So we urgently request National Treasury and the members of the Standing Committee on Finance to urgently correct this discriminatory provision by inserting in Proviso D the reference to foreign portfolios of collective investment schemes in hedge funds. And the effective date of that should be the effective date of 24th December 2024, which is the date when the definition of company in Section 1 was extended to include foreign collective investment schemes in hedge funds. So that is the answer. We appreciate that in November 2024, there was a discussion document on the tax implications of collective investment schemes. There was a January 2025 workshop by the National Treasury. We appreciate that is ongoing. However, those discussions are not relevant to the amendment in Proviso D. If you have an FSCA Notice Communication 5, which supports the establishment of feeder fund, hedge fund structures in global feeder funds, there is no reason why these global hedge fund and South African feeder fund structures are being discriminated against because Proviso D isn't amended. So Proviso D amendment and the discussion document, November 2024, are not related. Thank you.
Thank you. Saika, is there a question for you?
There is a question for us, Chair, in regard to Honourable Burke. So the SARS argument, in essence, is, well, we've changed nothing because you still can have the penalty or get free from the penalty based on the same culpability investigation. But as Honourable Burke has mentioned and posed in his question, that's the wrong statement. The question is rather, if we move the culpability investigation from a precondition to impose to a post-condition to remit, are we essentially finding you guilty before we've actually determined your culpability? And that is the right question. And the answer is yes, that's exactly what this proposal will do. It will essentially impose the penalty as a strict liability penalty rather than a behaviorable additional penalty. And therefore, SARS would not have to determine your culpability before imposing the penalty. And that's why we still recommend keep it from a due process and a fair administrative process that SARS, when determining culpability, still has to first investigate whether you are culpable before it, in fact, imposes a behaviorable penalty. Chair, that was all question for me. Thank you.
Thanks very much. Dr. Berg, follow-up question?
Chair, that's very insightful. Thank you for all the presenters. That being the case, especially the answer from Saika, can I recommend that the content team come up with either alternative wording or a different approach to what's now in there? I don't think that we as a committee can stand behind a SARS decision to find somebody guilty and then they must go try to prove their innocence. So my request to the team is that we come up with an alternative here. Because that does not, and I think it probably has the committee support that does not sound workable. And then, Chair, perhaps just a general point. I think today was really insightful, but I am expending a lot of resources trying to follow. So thank you to all four presenters. If there's any way to make these presentations more layman speak like, I think that would help the public a lot to be brought along. I know it's a big ask, but if we can take these technical inputs in future and make it really simple for people to digest, I do think we need the public to pay attention to what's happening, and that would help us all a lot. Thank you, Chair.
Thank you. I think what we are going to do, Dr. Peck, we'll have to give SARS and National Treasury to present their side of story. Usually when we conduct public hearings, After that, it is followed by the session where SARS and National Treasury respond. When are we going to do that, Sister Tebo?
Just a tongue-in-cheek comment that we will be giving them the chance to present their side, but they don't seem keen to do that for the public.
Yeah,
Next week, Tuesday. Next week, Tuesday, Chairperson, on the 2nd of December, SARS and National Treasury will be responding to the submissions.
Okay. So we'll meet again next week, Tuesday. They will take all the issues that have been raised by members and the stakeholders and respond accordingly. I think we're done with item 4, 3 to 8. Now we have to go to the summary. Do we have announcements? I heard you talking about the meeting next week. Can you talk to that meeting again so that we inform the stakeholders accordingly? Butle, Sister Teo.
National Treasury and SARS will be responding to the submissions made.
When? What time?
That will still be an online meeting, so stakeholders will be sent a link to join the meeting and any other interested party.
Okay.
From 9 to 12.
Okay. So that's that, colleagues, stakeholders, Treasury, SARS, media. Let's adjourn the meeting and meet again next week, Tuesday, same platform, to take this matter of the 2 bills forward. Thanks very much, colleagues. The meeting is adjourned.
Thank you. Thank you to the stakeholders.
Thanks, Speaker.
Thank you.
Recording stopped.